Hey guys, so we're going to talk about the pattern day trader rule. Basically, the pattern day trader rule was created by FINRA to help protect new investors from overtrading and blowing up their accounts. As you can see in the definition here, um, there's several key takeaways that we'll discuss in more detail, which are the main areas that you want to focus on. So basically, the pattern day trader rule is a regulatory designation that restricts the trader for 3 day trades within a 5 rolling day period, right? So if you execute a fourth day trade in that 5 day rolling period, your account will be flagged as a pattern day trader and you will be locked out of your account. Um, This is on the same account, and that is with a broker. So if you have a broker that is with a TD Ameritrade and you execute transactions there, those do not count towards the transactions that you would have maybe, let's say, with Webull. That would be a totally separate account and a different levels, a different level of threshold, right? Um, So the exception to this is a $25,000 margin account. Basically, that indicates that if you have $25,000 or more in your account, you are not subjected to the pattern day trader rule. If you execute any transactions and within the middle of that transaction, your pattern trade, your account falls below $25,000, your account will be flagged as a to be subjected to the pattern day trader rule. Okay, so just keep that in mind that if you fall below the $25,000 threshold, um, you will be subjected to it. So let's take a look at a scenario to help understand more what this 5 day rolling period and what's considered as a day trade versus swing trades. Okay, so in this scenario right here, this trader, the current day is on a Thursday. This green box indicates the current day, and these other 4 boxes indicates the 5 day rolling period, including the current day. And if we look back, we can see that there were day trades that occurred on Monday for stock number 2, on Wednesday for stock number 2, and on Thursday for stock number 1, as indicated on this table here. So this person has already executed 3 day trades within this 5 day rolling period. This purchase of stock 1 on Monday and the sell of it on Tuesday is not a day trade. Okay, that's more of a swing trade. Day trades are usually when you purchase and sell on the same day for that particular security or stock or whatever you want to call it. Okay, so if we advance the next day, as you can see, Friday is no longer a part of the 5 day rolling period. But because the 5 day rolling period only extends to Monday, we still only have practically 0. We can execute 1, but we will lock our account after we decide to execute that. Okay. Notice here on Friday, today, the current day, that this trader purchased stock 1 and stock 2 and plans to hold it over the weekend, over Saturday and Sunday. The market is not open on Saturday and Sundays. Okay. Nor is it open on certain holidays. So what that will do is it will not count towards the days of what the 5 day rolling period indicates. Okay, so if we were to land on Monday, the last day of the 5 day rolling period is Tuesday. But notice our account, the amount of trades that we can do now on a day trade went up by 1 because the purchase of S2 stock, that is a day trade, no longer falls within that 5-day rolling period. Okay? And we advance another day. As you can see, we haven't not been able to get these out of the 5-day rolling period, so nothing has really changed. But on Wednesday, we went up another one because of the 5-day rolling period is no longer extended to that particular transaction. Okay, so that's pretty much what the pattern day trader is. Day trader rule, it's 5 days rolling to where you're currently at. It's the 5 last days, not including weekends or holidays. It's for margin accounts, and it's for margin accounts that are below $25,000. Cash accounts are not subjected to this. However, the disadvantages of cash accounts is that it takes maybe 2 to 3 days to settle, where a margin account is instantaneous. Okay. Weekends are included again, and neither are holidays. So hopefully this helps everybody understand what the pattern day trader rule is. It's something you want to keep in mind because it can hurt you if your account gets locked and you have open transactions that are occurring. And, you know, it could go down and you won't be able to close it. I have heard of instances where, the trader contacts their broker and kind of pleads, ignorance, and they allow them to not be locked. But I can't imagine you not being able to do that only but once before they catch on to your game. If you find yourself that you want to be able to trade more, and rightfully so, if you are doing well and you're consistently winning your trades at 80% or above, you can open another account with another brokerage, and you'll get another round of 3-day trades within 5 days. Okay. So just keep that in mind. That could be something advantageous for you to do if it's going well. But what I would suggest is it's going to take you time to actually do these kind of trades. It's something that I would not encourage you to rush into because this rule is here for a very good reason. And a lot of people tend to overtrade and blow up their accounts. So, but it can be frustrating if you do know what you're doing, or you think at least you know what you're doing, and you are still subjected to this. Okay. All right, guys. Well, that's it for this particular content. Hopefully, some of you guys will subscribe as I push content out, and you'll get the notifications. Um, if you got questions, put it in the comments down there, and as soon as I see them, I'll respond, or you can ask your questions in the Facebook group. All right, guys, take care, and again, happy New Year and happy trading.